Well, first off, let me welcome you. My name is Nick Goodwin. I'm Chief Operating Officer for Anglia Innovation Partnership. As I think most of you will know, or have heard my name, or are aware of the role of Anglia Innovation Partnership. This session today is being sponsored by us, with the attempt to build a stronger understanding across the park about the opportunities of investment. Many of you will have heard about Cubis and Sapphire Capital and some of the investors that we're working alongside with to help you realise your commercial opportunities. But we felt that we wanted to sort of present a broader understanding of the options out there for you. And so we really wanted to work with Hannah Smith and Laura Hood from Anglia Capital, New Anglia Capital, and Anglia Capital Group, who have developed an investor readiness program for us that focuses on angel investment, which is their centre of expertise. They may well be familiar to some of you on the park because they are based in the region and have worked in Cambridge and Norwich. The aim of today is to give you a bit of a window, a bit of a taster session about what angel investment is. And they're going to walk you through how that works in practice from their perspective and how that works for companies and who they can help connect you with. But our desire is to try and get some feedback from you about whether you think this sort of activity is something that you'd like to engage in more formally through a program that would lead you to an opportunity to pitch for angel investment at the end of a structured program. So we haven't fully commissioned the program yet, but we would like to. And so once you've reviewed this session today, we are recording it, so we're going to be able to share it beyond the session so that others who can't join us today can check in and see if it's something for them. But if that's something that you would like to do, then you can please reach out to myself or Hannah and Laura, and there'll be a survey Google form that will be shared today after the call to get some feedback on your appetite for joining us on a sort of a more extended journey, and hopefully some good outcomes for angel investors and for companies that can qualify for that. So Hannah and Laura, I think now's probably time to hand over to you. I'm going to sit and lurk in the chat. So if you've got any questions that I can answer that Laura or Hannah can't, then I'll do so. And then we'll try and answer questions, if not during the call, following up after the session today. So Hannah, over to you.
Thanks very much, Nick. And hello, everyone. It's fantastic to see so many of you here. My name's Hannah Smith and I'm the Managing Director of Anglia Capital Group. And I'm joined today by Andrea Finnegan, who is the Non-Executive Director of Anglia Capital Group and also an angel investor in her own right. Want to say hello?
Hi. Hello.
And also Laura Hood, who is the Halo Programme Coordinator.
Hello. Good to see you all.
So I will start by hopefully successfully sharing my screen and we'll kick off. So just before we start, so for those of you that don't already know us, Anglia Capital Group is a network of over 80 angel investors across Norfolk and Suffolk. We work with innovative early stage companies in the East Anglia region to pitch them in front of our angels to hopefully secure some angel investment to help them scale and grow. We're absolutely delighted to be delivering this introductory session for the Halo programme today, which has been designed to give you some background to what angel investing is and whether it could be of value to your early stage or startup business. We've drawn on our own network of founders and investors to provide you with hopefully some real insight throughout this presentation. Before I move on, I will just take a moment to thank our other partners involved in the Halo programme, the University of Suffolk, Tech Partners, RSM and Burkitt's, and of course, Anglia Innovation Partnership for facilitating today's session. So over the next hour or so, we intend to cover the following. What is angel investment? What are the pros and cons of angel investment, and where does it fit in amongst other forms of finance for businesses? What does a business look like that's suitable for angel investment? We'll put ourselves in the shoes of the angel investors themselves and determine what they're looking for in an investee company and why they're willing to take the risk. We'll discuss what a startup needs to have in place in order to be seen as ready for investment, and also the process that you might go through to secure angel investment. What we hope is that any entrepreneurs in the room today will go away understanding the value of angel investment and know whether it's something you might want to pursue for your business, either now or in the future. This is, as Nick mentioned, an introductory session to the full Halo program. So if after today you are interested in going on the full program to become investment ready, we will be circulating a feedback form after this meeting. So do indicate your interest by returning that. And Laura, who I just introduced, will go through exactly what the full course will cover in a little while. There will be plenty of time for questions as well, so feel free to pop any questions in the chat as we go along and as you think of them, and we'll do our best to pick those up at the end. And we'll also be available after this meeting, so do reach out to us if you'd like to speak to us on a one-to-one basis. So let's start with the obvious. What exactly is angel investment? So angel investment is typically one of the earliest equity investments made into a startup company. And it's actually the largest source of early stage capital in the UK, with around 2 billion invested in this form in the UK per year. Angel investors, otherwise known as business angels, or more commonly just angels, are almost always wealthy individuals. They're often entrepreneurs themselves who've built and exited their own companies, or successful professionals in their field. Anyone can be an angel. There's no qualifications needed. All that's required is some excess wealth, and also the Financial Conduct Authority in the UK dictates that they must sign a self-certification form to say they do have enough wealth or enough experience in the finance sector to be an angel, because this form of investing is one of the most risky methods of investing. While angels can be found individually, sometimes they more commonly band together in investor networks such as Anglia Capital Group, and that's for a variety of reasons. Firstly, it means that the deals in which they're presented with have been screened and selected from a bunch already, and it stops them being bombarded with business plans, which they probably would find if they publicly announced that they're looking to invest. It also gives them the ability to work alongside other angels, so they can draw on each other's knowledge, skills, and experiences. And it provides the opportunity for them to syndicate, which means essentially to co-invest alongside each other into a business, and that helps to share the risk. There's plenty of other reasons why angels decide to join organized networks, but those are the most quoted. I do keep mentioning risk, and that is because angel investing is very high risk. You've probably heard that roughly 50% of startups fail. And because of this, angels enter into these types of deals expecting high returns. So most angels will aim for a portfolio of between 10 and 20 companies. And you can maybe expect 40 to 50% of those to fail. Maybe another 30 or 40% to give a modest return. But it's the sort of 1 or 2 in 10 that will achieve the return that they're always looking for when they make an angel investment, which is sort of 10 to 20 times their investment. So with that, I guess if you're planning to seek angel investment, my first and main piece of advice to entrepreneurs is that when you pitch in front of a business angel, you are promising them that you genuinely believe you can multiply their money significantly if they hand it over to you and your business. So there's many different forms of finance for business, but they can broadly be boiled down into 3 key categories: debt, grants, and equity. Most people are aware of these funding types, but I'll go through them because it is important to understand the key differences. So debt is where you borrow money and then repay it. So usually repay it within a defined timescale and with interest charged on top. Debt funding is commonly provided by banks, and depending on the level of risk that a bank perceives, a business might be required to secure or guarantee the loan, which means to provide collateral. And even in those cases, a bank will still likely wish to see profits in the business, which means that for early stage businesses that can sometimes be a number of years away from profitability, debt just isn't always an option. There are government startup loans out there which could suit some types of businesses, but they only offer up to £25,000. So it's only really applicable where you don't need a huge amount of money to start up and where you'll be generating revenues fairly quickly in order to repay it. But the key upside of debt is that if you have got enough commercial traction to take out a loan, you don't need to give any shares away. Grants, there's no financial cost to accepting grant funding. It usually comes from governmental or charitable bodies, and it comes with strict instructions on how to spend it. Grant funding is great, it's extremely useful, but you shouldn't really look to build a commercial business around free money because access to grants can vary with economic forces and political forces too. So locally, for example, the New Anglia LEP offer a number of grants for businesses. However, they're usually restricted to being used for the purchase of tangible capital equipment, things like machinery. Also, a lot of grants will only fund a certain percentage of a project. So that means that the founder still has to fund a proportion of the project through other means. Equity is the camp that angel investment falls into. And it's where an investor puts money into a business in return for shares in that business. The idea from the investor's perspective is to get more money back out of the business in the form of dividends or by sale of the shares that have increased in value over time. And equity is perfect for early stage businesses that need an injection of cash to help them grow to profitability. So within this category, the 4 main forms are friends and family, angel investment, venture capital, and crowdfunding. Friends and family is exactly what it says on the tin. I guess if entrepreneurs are lucky enough to be related to or friends with somebody with a bit of wealth, then you can sometimes call on those relationships to help give you a kickstart in your venture. Goes without saying that there's obvious strings attached to this, particularly if the family member or friend doesn't truly understand the risk involved, can sometimes ruin relationships. Angel investment, as I mentioned, is alongside friends and family in the position of earliest forms of capital in a business. It's money invested by wealthy individuals that you aren't necessarily related to or friends with. Venture capital, on the other hand, is pools of money or funds that are run by fund managers. Fund managers have certain target returns that they're pressured to provide to their investors. And their investors are the people or the institutions that have put their money into that pot. VCs typically invest larger amounts than angels into more developed, later stage businesses. And that's because they want to accept slightly less risk. VCs will have specific criteria relating to how much revenue the business is turning over. And actually, from recent conversations with our VC contacts at Anglia Capital Group, this tends to be in the range of 500,000 to 1 million of annual recurring revenue, depending on the VC. Our friends at Foresight and Cambridge Innovation Capital are two local VCs that are usually quite happy to talk to businesses at an early stage and give an idea of what they will require from your business before they'll consider funding it. So if that is a route you want to take, I'm happy to make an introduction. In recent years, there's been also a rising number of what we call early stage or seed stage funds that tend to invest alongside angel investors. But they tend to want to co-invest alongside angels because of the other things that angel investors bring with them into a company when they invest, such as their experience and their contacts. Anglia Capital Group, for example, has 3 early stage co-investment funds in its group. But New Anglia Capital, the Low Carbon Innovation Fund at UEA, and the East of England Co-op Fund as well. So these funds, they tend to rely on angel networks to provide them with investment opportunities. So they're quite similar in a sense to any angel investor looking for investment opportunities. They can just tend to do bigger tickets. And relevant to most of you on the research park is, of course, the Cubis Innovation Fund that Nick mentioned, run by Sapphire Capital. So if you're a founder, you're incredibly lucky to have access to that fund by being part of Norwich Research Park. They can, I believe, invest up to 50% of your equity raise, up to a maximum of £150,000. So again, you'll need to get that the other 50% from other probably private sources, such as angel investors. So in a typical high growth business journey, you'll likely find multiple rounds of investment of these different types. So you might start off, for example, with a small raise from friends and family of say 50k, or you might bootstrap by self-funding the project. Then you might move on to a larger angel investment round, say 500,000 from angels and early stage co-investment funds. Then when you start to grow a bit more, you'll get into VC territory. PE stands for private equity, and they might invest upwards of 1 million. And ultimately, you're aiming for an exit. So an exit event is something that allows all of the shares in your business to be bought, and therefore it provides your investors with a return on their investment. So that can be via an acquisition, which is where a larger company comes in and buys your business. It could be an IPO, or initial public offering, which is where you list on the stock exchange, or it could be an MBO, which is a management buyout. They all offer an exit for investors. Last thing I haven't touched on yet is crowdfunding, which I'm sure you've probably all heard of. It's become all a hype in recent years, but don't be fooled. The majority of crowdfunding campaigns fail, sadly. So most businesses you'll find that raise money via crowdfunding platforms actually raise the majority of the round offline with angel investors. So that means that by the time they launch their campaign, it looks as though they're overfunded very quickly, which then leads to even more investment from the crowd, who develop what we call a herd mentality. That said, crowdfunding can be an extremely effective marketing tool as well as a fundraising tool. So it can make it a good candidate for businesses that intend to sell to consumers, because it can grow their customer base as well. Let's hear from some real founders on the topic of grants and crowdfunding as a means for capital growth.
Yeah, both actually. So we've had both grant funding and we've done crowdfunding as part of our last round where we took angel investment as well. So it was all together. And so I'll tackle them both separately because they are a little bit different. Grant funding can be quite manually laborious. So filling out applications. My recommendation with that is that almost all applications have the same questions in them. They might be slightly changed a little bit. So if you can have a doc of generic answers for grant applications, then it's much easier to twist and mold them into the right application rather than starting from scratch. And then if you keep that master doc updated, then it actually is going to allow you to sort of never really need to sort of think too much on the spot with a grant application. The only other thing I'd say with grants is that they are very niche a lot of the time. It's quite hard to find very generalist. And if they are very generalist, then they're very, very competitive. So you either need to be really, really good at getting your proposition across in writing without your personality, right? You know, you've got a limited word count and I really hate it, but but you need to, you know, it's a skill in itself. And we've had some support through that as well, through Innovate Edge, through the Innovation Grant Mentoring Project here in Norfolk, and then also from our advisors as well, who sit as Innovate assessors. So even with all of that advice, it's still quite hard for a grant application. On the flip side of that, the crowdfunding aspect, I think it's an absolutely brilliant tool for bringing your community into your company.
Oh, that's all right.
As one line on the cap table, so it doesn't become too messy. But it also is a really good way of engaging them, and they become your biggest fans because they are also vested into your company then, not just because of the emotion, but because they put money into it. And again, that comes with lots of benefits, as with any other angel investor. But also, it's going to mean that you can potentially exponentially grow your customer base because they will shout about it more than maybe your average angel investor would. So that's one bonus of it. However, there are many, many challenges with crowdfunding. Don't do it too early. So we did it pre-revenue, pre-product, and it was really hard. So we're really proud that we've got like 350 people for a crowdfunder. But, you know, it's really difficult to engage people who don't know you already when you're not showing them anything other than like a really pretty pitch, right? A pitch deck or a video. And it's the same with angel investors, but with angel investors, you can nurture that a bit more. So you can have one-on-one meetings, you can show them the MVPs. With a crowdfunding platform, your pitch is up there and that's it, right? Like, so then you've just got to hope and you've got to put the marketing in. It takes a lot of time. So I think, yeah, crowdfunding is a really good way to engage your community, but probably better to be done when you have a pretty large community there who know and use your platform, because then it's much easier for them to buy in on it because they're using it, where you don't have to sort of do the hard sell.
Yeah, I do. The grants, first of all, because we've had some frustrating experiences, but some positive experiences. I guess the frustrating ones have been around quite a lot of the EU funding that is available because they have some particular criteria around the financial situation of the business in terms, and it really is quite difficult if you're a startup, if you haven't reached profitability yet, if you've got some accumulated losses from previous years, you'll fall foul of quite a few of the EU criteria for EU funding grants. So that's been quite frustrating because a lot of these grants are supposedly aimed at startups and new and growing business trying to scale, and yet so many of those businesses aren't going to be able to meet the criteria for that funding. One of the best routes we found, though, was with the DTI, which isn't EU funding, it's UK government funding. And we've had some excellent help from DTI in terms of their internationalisation funds. Not too difficult to, there's not too much paperwork to fill in, and potentially up to 40–50% funding for initiatives that are going to expand your sales internationally. So definitely worth contacting your local DTI rep. And then in terms of crowdfunding, I think it's again about going into it with open eyes, because you can get carried away with all of the publicity and profile that crowdfunding can bring if it's successful and if it's pushed well. But increasingly, I've found that it's quite expensive. especially if you're not raising a significant amount, anything under probably $500,000. It gets very expensive because they have their fees are based on percentages, and there's always a minimal amount as well. So, and also they will always encourage you to spend more on the marketing and publicity. So they have add-on services which they sort of expect you to take. And then the other thing which people don't realise with crowdfunding is that the percentage that they expect, if you're trying to raise, say, £1 million, increasingly they're looking for you to bring 60, 70, sometimes 75% of that to the table already committed. So when you see a crowdfunder go live and all of a sudden they're 75% funded, often that's nothing to do with the crowdfunding platform. That's people, existing investors or new investors that you're bringing in who have committed, but they put it onto the platform to obviously make it seem like you've had a fantastic start to it. Yeah. So quite often you can put a lot of time and effort into raising 10, 20% of your overall raise. And you do need to spend an awful lot of time and effort on it in terms of the marketing, the awareness, and pushing it out to people to make it worthwhile. So it has got its place, definitely. The final thing on crowdfunding is that quite often their investors' agreement, the shareholders' agreement, which they have in place, just be very careful about how that's written, because sometimes they're looking for more advantageous terms and conditions than standard investors are. They are very protective because they're what we call a nominee investment route. They represent the hundreds of people that micro invest in you. They've got very tight, sometimes restricted conditions in their agreements, which you wouldn't normally see in a general investment agreement.
So, apologies for pausing a couple of times there. I'd lost all your faces, so I was trying to get them back. So bear with me 1 second. There we go. Sorry. So let's look at the funding journey of a company that we all know, Google. So in 1996, co-founders Sergey Brin and Larry Page launched the first working viable product, the original Google, if you like, on Stanford's University network. And at this point, the only funding they had was from themselves and their personal credit cards. In 1998, they received a $100,000 investment from their first angel investor, Andy Bechtolsheim. This is when Google Incorporated became a real company. And in the same year, Google's founders also received an additional $900,000 from friends, family, and fellow PhD students at Stanford. So the company grew, and in 1999, Google received a $25 million investment from 2 US venture capital firms. And finally, in 2004, Google went public with an IPO that raised $1.67 billion, which actually made it one of the largest tech IPOs at the time. And Andy, their first investor, turned his $100,000 investment into a staggering $1.5 billion. Very successful angel investing, if you ask me. So, as you can see from Google's journey, angel investment can be a fantastic catalyst for the exponential growth of a business. But it's not just about the money.
it wasn't really, the money was incredibly important, but with the benefit of hindsight, it was actually Patrick's commitment to me and the vision that was more important. And I didn't actually appreciate that as a founder, how instrumental he would be in helping me develop my business acumen and business skills to actually help develop and grow the company to what it is now today.
100%, actually. I think that almost all angels, the value is actually not just the capital, and a lot of that time, it's actually more valuable the other stuff. And that other stuff is really their expertise, their contacts, their specific sector knowledge. So they might not be related exactly to what you're doing, or have come directly from that exact same space. Although I would recommend sort of reaching out to people who have some sector knowledge of what you're doing. But anyway, those investors who have backed you want you to succeed because it's their money as well. They want the return. So they'll do anything they can to make sure that happens. And that means if you are struggling with, I don't know, finding the right hire, finding the next batch of investors, getting your platform tested accordingly, whatever it might be, your accountancy, really, literally anything you might be coming up against as a business owner, it's very, very likely that angel investors have the ability to assist with that, or at least put you in contact with someone who can and then assist with it.
We were really open to an angel coming on board and helping us in areas of our relative weakness, which may be around logistics, distribution, but also perhaps on the finance strategy side of things going forward. And this investor certainly had that experience. So when he then followed up with an offer to invest and take part in that round, that was really perfect. And he then actually ended up being our investor rep on our board. So he wasn't a director, didn't want to be a director, but all of the other leading investors who took part in that round said that they were happy for him to represent them on the board. So when we have our quarterly board meetings, he comes along as an investor rep as well.
I've been very lucky to get lots of angel investors with lots of different areas of expertise. So if I have a problem, if I'm like, I don't know what to do about working with this insurer, I know who to ring. If I need an understanding of a problem that I've got in risk space or with the FCA regulation, I've got somebody that I can ring. And they're always there, on point to help us. So I'd say, that help and support and the introductions has been absolutely invaluable to my business, and it's been almost more valuable than the cash itself.
So in 2015, Harvard and MIT professors actually did a study and found that angel-backed businesses are more likely to succeed than those that go without it. And the reason for that is all of the ancillary connections, experience, skills, mentorship that angels can bring with them into a company. And pretty much all of the successful founders that we've worked with have said that having somebody who cares about you, I'm in much video, look, is more valuable. But it is important to say that there are drawbacks to taking angel investment, and it doesn't always turn out to be the perfect love story in all cases.
Had a fairly bad experience with an angel investor, but she was particularly involved in our sector and had production facilities and distribution and sales networks. So we were hoping that that would allow us to grow very, very quickly. Again, and this is obviously one of the things you learn, that sometimes things just don't work out with investors, and you don't have the right relationship and communication with them. So we managed to get a UK-based, plant-based fund buy her out.
So, as with any relationship, things can turn sour. These people have put a lot of money into your business, so it's logical to think that if you don't necessarily hit the targets that you laid out with when you pitched, that they might be a bit unhappy with you. Angel investors are people. Every person's different. So you need to be as selective about picking your angels as your angels will be about selecting you and your business. They will do their due diligence on you, but you also need to do your due diligence on them. Particularly as in the case with Mike there, if they're promising you something that you intend to build into your business plan, if you like. You also need to look after your relationship. Treat it like any friendship, really. If you don't speak to them for a few years, if you don't let them know how you're getting on, they're probably not going to be very happy if you turn around and ask for more help. Apart from relationships, the obvious drawback is that you will have to give away some of your business in the form of shares. So this means you really need to weigh up. You need to acknowledge that there is a cost to taking equity, and you need to weigh up that cost and decide whether it's worthwhile. So the question you need to ask is, will my business grow more and be worth more if I take this investment, or will it do just as well if I go without it? The other thing to think about is the fact that once you take investments, you're not the sole owner of your business anymore. So you might not be able to make all of the same decisions that you could when it was just you. And it also brings certain governance requirements and responsibilities with it as well. Over to you, Andrea.
Hi, hello everyone. Just a brief introduction. So I've been an angel investor for 12 years now, having come from the financial services sector. And I tend to focus on investments in the education or environmental sector. And you'll find that angels tend to want to invest in areas where they have some expertise. And so the idea is that I'm now going to take you through the angels' perspective. So Hannah's given you the company's perspective. Please do feel free to pop questions in the chat as we go. It would be good to get some feedback from you, the kinds of areas that you're interested in. So the first question for you is, what do you think is the most important aspect when an angel is looking at investing? And now we've got a poll that we're going to run, so please do vote. Is someone going to pop the poll up? Yeah.
Okay.
I'm just wait for everyone to. Okay, I think that seems to have stabilized. If you end the poll, then I think everyone can see the results of that. Great. I mean, I think the one thing I would say is you have a very good understanding of what angels are looking for already, because actually the number one thing is the people. So we invest in people, and the track record of the team and the experience as well. And then the second one would be the market. So obviously the people need to be selling a product that there is demand for. So that is number two. And then the third one, interestingly, is exit. Now, nobody here has voted for exit. What we like to see is that even before you've launched your business, you know how you're going to sell it. because that's the only way that we can get our money back or get a return. So I think right from the start, even when you pitch to your first angel group, make sure it's clear how you're going to exit. So that could be a trade sale. In fact, that's usually the most common route. So you're going to sell your company to somebody else in the business, but are just a larger company in that business, or it's an add-on to their business. I mean, people talk about IPOs and they're great. However, they are very complex and they are very costly. So that's not always the best exit route. Again, something that we can explore in the program. So I've been involved in 3 IPOs to date, and I can say that it is a big risk to list on a stock exchange, because it doesn't necessarily mean it's going to be successful. Often it's much easier to have a negotiated exit with another company. Okay, thank you. So what criteria, what does a suitable, sorry, I'm on poll still here. So what does a suitable business look like? We have a number of criteria. So it's got to have high growth potential. Now, we're not looking for service businesses. So if you're in the process of setting up a business that's going to provide services, I guess a good example would be, given that most of you are from the research park, is if you were going to offer a service for genetic testing, or you were going to offer some kind of other lab testing as a service business. That's not something that we would look to invest in. Now, I have invested in the past in a business that did that, but they did it to keep their cash flow going and to pay their ongoing costs. However, the idea that I invested in was the growth potential of a new test. And I think one of the risks, if your business is providing a service, is that you become too focused on the service and not so much on the growth potential of your new product that you have to launch. So if you do have a service, make sure you don't forget why the angels invested in your business in the first place. Then it has to be innovative. So make sure you know your market and you know your competitors. As I said before, exit oriented, so we've talked about that. You need to have a minimum viable product, not just an idea. So I remember Hannah and I, it's got to be like 6 or 7 years ago, we went to see a company with a whole group of angels in a warehouse in the middle of a field in Norfolk that had come up with a revolutionary idea of a fertilizer that also retained water. And we were given a demonstration in what looked like a big barbecue. And I think it was the first time they had done it. The whole thing went up in smoke. We were all told to evacuate. And so clearly that wasn't an investable business because they should have had their product sorted before we arrived. Now, that's not something that an angel group can test in advance because we don't go into the lab. So it's up to the companies really to make sure that their product is ready. You need to solve a clear problem. If you can't explain your idea in 2 to 5 minutes, it's what's called the elevator pitch. If you can't explain it to a stranger, then an investor is unlikely to invest. Often companies do get frustrated with us, and we can't possibly know everything there is to know about all sectors. And so I think it's important that you should have a product that anyone can see the point of. So you need to take a step back and test it on a lot of people to see whether they would see the need for it, even people outside your sector. You need to have some traction. So what does that mean? That doesn't necessarily mean you need to be revenue generating, but it does mean that you need to have trial feedback, or you need to have some beta testers, or even heads of terms, say, with a company that's willing to buy your product, something like that, to show that there's third-party interest. And in terms of the amount of money that you need, anything between 100,000 and 1 million, although we do move to larger numbers than that. but anything smaller than that isn't really suitable for angel investment, and anything probably over 2 to 3 million, you're starting to look at venture capital investment rather than angels. Angels, as Hannah said, group together. So you'll get individual angels putting anything from 10,000 to 500,000. We've seen individuals put in to meet the total. And we do work together with other networks. So we don't compete, and we don't see it as a competition. We see it as a real collaboration. And therefore you have to be prepared to pitch to a number of different angel groups as well. And I've already mentioned management team is very important as well. So here's another one of our angels.
Several reasons, really. I think I've got to a point in time where I've got the ability to do some investing, and obviously you can do the conventional routes by putting it into stock market and all the rest of it. But I just feel that well, obviously there are tax incentives from being an angel investor, which is a big criteria. But also, I think there is, as a founder myself, I understand the value of angel investment and how difficult it is for small companies to get going without angel investment. So and locally, it's great to to be able to support the sort of East Anglian infrastructure. So that's really the main thing is. And actually, I suppose being really sort of mercenary about it, if you hit a good one, then there's a potentially pretty good return of investment, actually. But that's not the prime incentive. I mean, it's more about sort of interest and supporting the local economy and as a tax efficient way of potentially getting a good return in the future.
Well, for me, angel investment is part of my investment portfolio. Obviously, it sits at the riskier end of things. But I do it really because it gives me a sense of being much closer to the investment, and it provides the opportunity to add value in different ways. From an investment point of view, obviously the tax advantages are a consideration with things like EIS. But mostly, I think it's also because it provides a sense of achievement. When an investee company makes it and the founders realise their dreams, that's quite a good thing to be a part of.
And I think I would reiterate all of those points and agree with those as well. I think for me, one of the most interesting things has been, having come from a large corporate background, is actually working with small businesses and seeing how nimble they are, and also the different perspectives that you get from working with startups. I think one thing I did want to mention that I didn't mention previously is that in terms of the tax breaks, so yes, that's great for the angel investors. There are also tax breaks for social enterprises. So if any of you are looking at starting a social enterprise, then there's social enterprise investment tax relief, which is similar to SEIS and EIS tax relief. So again, as I said, I'm interested in education and environmental companies, and also social investment too. So that's why angels invest. And what puts off angels? I think this is quite important as well. And as Hannah said, the relationship between the company and the angel is key. And so a lot of it is around personality, but let's hear what Richard has to say.
Well, a poor pitch for one thing, droning, boring, not much detail, too vague, lack of passion, but on the other hand, you also don't want people that are wildly over the top on the passionate side, and especially if the pitch is basically unrealistic. I think the second thing that puts me off is if they act as though they've already got it cracked. The products and services are absolute world beaters, and all they need is my money. That's also slightly off-putting, to put it mildly. A badly thought out business plan, especially in the assumptions. Every business plan includes assumptions. If you're missing areas of cost, or anything that needs to be done to deliver the strategy, that's off-putting, because it means you haven't really thought through, what your business is. Products and services with no really clear differentiation or added value, that's another no-no. Can't answer questions on competitors or markets or risks or priorities or use of money or the valuation. You shouldn't have to be able to answer everything, because you can provide some follow-up, but you should be able to deal with most of the questions. If you can't deal with most of the questions, then you're probably not quite ready.
The big thing that puts me off is unrealistic business opportunities, and I understand that you have to go in and be very positive, but when you push back on some people, they say, so what's your barriers to entry? What's your competition like? They are very, very unrealistic in some situations. They say, yeah, it's a really busy market, but I'm sure I've got the opportunity to really compete in that market. And that's a red flag to me, actually. That's one of my key criteria is barriers to entry and competition.
So there you've heard a very honest view of what puts an angel off, and here's a few others that angels have come up with. I mean, I think for me, one of the key things is the honesty part. We don't expect you to know everything, and so it's okay to say that you need help in certain areas. And actually, that's where angels can be very useful, because they can point you in the right direction. They can make the connections. I think mistakes in the business plan are fundamental. So I know when we did the poll earlier, business plan wasn't top of the list, and it's true. Business plan is often it has to be there, and we don't expect you to deliver to the business plan, because actually nothing ever does go according to plan. However, if you're projecting, as I saw in one case, there was a new it was a new metallic mix for a cycle frame. So it was a company that was producing bicycles. Had projected that within 3 years they were going to have 100% of the UK cycle market. They obviously hadn't thought about the numbers or thought it through, and nobody had checked it. And I think one of the other things I would say is that if you're the entrepreneur and you have the idea, then don't just pass the finance responsibilities over to your accountant or somebody who just does finance, because as the entrepreneur, you need to own your cash flows, you need to own your forecasts and know where the business is going to go. So I think that's a really important one. I mean, it's always a classic. You've all watched Dragon's Den at some point, and the entrepreneurs can't answer the finance questions because they think it's somebody else's responsibility. Okay, then what do you need? So you've decided that you want to go for some angel money, and then there are a number of things that need to be ready. So data room needs to be prepared that has all the key information that the angels want to look at. So I've talked about the business plan. It needs to be there. It needs to be realistic, and you need to know what it says. The same with the financial forecast. The up-to-date capitalization table. So what's this for those of you unfamiliar with it? It's just a list of the shareholders, how much they own and how much they put in at each equity round. So you can see how the valuation of the company has progressed, and you can see who has put what money in at which stage. One of the things that I always make the assumption is that if you put in an amount at the start, you can expect the company to come back to you at least 3 times in further rounds. So I always set aside 3 times the amount that I've put in the original round, because businesses do need cash flow and things don't go according to plan. And the last thing you want is for there to be a cash flow problem. Obviously, you need a pitch deck, shareholder documents. That would be things like the shareholders agreement. And we're going to talk a bit more about that and have a bit of a breakout discussion on that. There's the subscription agreements that have to be in place, the articles, which are part of the corporate documents of the company. So the left-hand side in bold are the ones which you definitely need. On the right-hand side, this is very much dependent on whether it applies to your business or it's needed. So usually our angels do like SEIS or EIS investment because of the tax breaks. And also this applies to CETA, SITR, you can have as well. And we have had a few investments which didn't have that. And the reason that the angels invested in that particular case was because they were, instead of investing in a diversified portfolio, there are angels who like to get involved in the business. So they put all their eggs in one basket. They actually take a management seat in the company and they then drive the company forward to turn it around, sell it, and then move on to the next project. So there is that type of angel if you're looking for somebody who you want to manage your business as well. Then, I mean, you need to have evidence of patents if you've got an innovation which you need to protect. And importantly, market review, one of the other angels already mentioned, and technical reports from third parties. A lot of it is if you've got a third party that can back up what you're saying, then it'll stand you in good stead. Okay. As I said, we were going to have a breakout session now. So what I thought would be useful is that you're probably thinking, well, how is this going to change our business? What happens if we bring in other shareholders? And in the shareholders agreement, there are what's called reserved matters. And that means that you as a founder or as a company can't make decisions on your own anymore. So you might have been used to making all those decisions. However, now you've got new investors and you have to think about how they get involved in the business. And so what you find is there's usually an investor director who represents all the angels. So I'm an investor director on 2 businesses where I represent the other investors. And it means that certain decisions of the company are made by the board, including the investor director. But there are other decisions where the shareholders don't want to let go, and they want those decisions to go back up to the shareholders for a majority shareholder decision. So thanks, Lilia. See you soon. So what we're going to do is we're going to give you 10 minutes in 3 breakout groups to decide where each of these matters on the left-hand side fits, and whether it's a shareholder consent matter or a board matter. And that's the discussion that's to be had. If you as a company feel comfortable giving up control over those things. So we're going to put you into breakout groups. We're each going to pop into those groups and then give you some guidance on that. And then we'll be back in 10 minutes to complete the session today. Hello again, everyone.
Hello.
I think that was a bit short. Well, it was for our group anyway. We didn't manage to finish. So I don't know how the other groups did. Did you finish?
We just about finished, but we had a lot of we were on the fence for quite a lot of them. We put a lot in the middle.
Yeah, so I think it would be useful actually, maybe just for me to go through the individual points. And what's key here is that it's a negotiation. So there are some things that the angels are going to insist on, and there are some things that the company is going to insist on. And then there are also some legal requirements. So what you find is that obviously company law requires certain things to be done in certain ways. And there are a number of documents which govern the way that the investors interact with the company. So you've got the articles, which are part of the constitution of the company. You can't go against the articles. And so you have to bear that in mind as well. So interestingly, is it worth me just screen sharing? Okay, actually, Hannah, can you just bring up the points again, the slide that you had with. That's it, great. So make any material. What I'm going to do is just run through them and say usually where they start. So in a draft, and then areas that are up for negotiation between the founders, because bearing in mind that to the point which the investors come in, the founders have made all the decisions themselves. So make any material change to the nature of the business. This is always usually a shareholder matter, because that's what they invested in. So, you know, if you said that you were going to produce cars, you can't just decide to produce tinned tomatoes instead. Then enter into a joint venture or partnership. Now, that can actually just be a board matter, because it's considered part of business as usual. And if it is part of your business to enter into partnerships, then your investors should let you do this. However, if you could potentially change the way that your business operates, i.e. you're transferring some of the value of the business to your partner, you're transferring your IP to your partner, you're sharing the IP with them, then this will be up for negotiation. So depending on the type of business, you can expect the shareholders to push back and say they want it to be a shareholder matter. Appointed director, that's usually a board decision. However, you'll notice that with a lot of the board decisions, I'll say however, because it's very dependent on the circumstances. So appointing a director is usually a board decision. However, the investors may want to be able to appoint a director, and therefore they have the right to appoint an investor director to represent them. I think I've already mentioned that model. And also, if you're a large shareholder, if you're putting in a lot of money, then you will definitely want to say over the directors that are appointed. So that may go back to those particular shareholders. For example, any shareholder owning over 40% might have more of a say, and that could be incorporated into the shareholders agreement. Approval of the business plan, that is usually a board matter. The reason there's no point in putting it back to the shareholders is you'd never get agreement, because it would take too long to get approval. Plus also the board should be able to manage the company and decide on those things. Create a subsidiary, that should definitely be a shareholder matter to start with. And this could change the nature of the business. It could involve the transfer of assets, and that's why it's usually shareholder matter. Dispose of an asset that has a book value greater than 25,000. So this is usually a board matter, but it could become a shareholder matter if the business is particularly dependent on a particular asset. And again, the thing that's up for negotiation is the amount. So depending on what your business is, that 25,000 is negotiable. The same with the next point. So the next point is your indebtedness. So in this particular instance, greater than 50,000, this is a number that I've seen in lots of different startups. Again, it may not be the right number for a business that has a much larger budget, but again, the amount is up for negotiation. Interestingly, the indebtedness is usually a shareholder matter, but you as a company may be able to negotiate that and make it a board matter. Commence litigation. Now, this is an interesting one, because you would expect that to be part of the business and the business as usual. I mean, hopefully you won't have litigation all the time, but I have invested in a company which had a large US interest, and the US is quite litigious. And so there were a number of different cases against the company, particularly challenging the IP. And there, because of the cost involved in litigation, you might find that moves to a shareholder matter. Remuneration to an employee in excess of 35,000. So again, the 35,000 is probably up for negotiation. The investors would expect quite a lot of sweat equity. That means that the founders work at a salary that's below the market rate, because that would reflect their shareholding. But again, that number is up for negotiation. And then declare dividends. So this is usually well, it's a board matter, and it's a proposal by the board, but very often the shareholders like to have the last say at the end of the year to confirm the year-end dividend, and also approval of certain types of dividend, because a dividend could be a way to circumvent some of the other restrictions in the agreement, and therefore the final dividend decision remains with the with the shareholders. Are there any questions on that? I mean, hopefully you found it useful, the kinds of things that you have to consider.
I've got a question.
Yes, of course.
What's very interesting, just the way this is written, that incur indebtedness greater than 50k, which we said, should really be a shareholder decision, but we've also agreed that the business plan can be approved by the board. So the board could approve theoretically 500,000 debt themselves, and therefore that would then be allowed to be take place. So there's a bit of a sort of conflict in that point, isn't there?
There is, and actually I think it's interesting you point that out, because that's a loophole, depending on where the matters end up. Because if that matter ends up at the board, like you say, then the board can just override it and put it into the business plan. And I think that's why one of the key things when you go through and you move the reserve matters between the different categories, you make sure that you're covered. Now, obviously, if you're the company, you're quite happy with this. But as an investor, I'd be looking to see, well, if I've moved everything down to board level, then can that be circumvented? So yeah, it's a good point. and that's why never accept what the lawyers give you. They'll give you a good draft as a starting point, but you as a business are going to have to live with this and actually try and implement it. And usually you find that implementing it is can often be quite difficult. And I've had a situation where a shareholders agreement didn't work at all, and the shareholders ended up falling out, and there was a dispute, and dispute resolution had to be instigated. So it actually makes sense to agree something that works at the start. I also had another example of a startup who had just signed up to something that had come out of one of those automated legal docs. You know, there are some law firms that provide you with automatic documents, and that had put in a limit on the valuation of 3 million, which meant that the founder could never get more than their share of £3 million, but the company was actually worth 10. And so one of the things was actually getting the shareholders to agree that the founder could have a greater stake, because it was something that had just been produced by the automated system. Okay, thank you. Then let's move on. I mean, hopefully that's given you a kind of flavour of the kind of discussion points that are really important when it comes to negotiating with your angels. So now we're going to go back to Hannah, who's going to go through the process. Oh, you're on mute.
Not sure how I managed that. I just said it was very interesting. Thank you for the real examples as well. So So now you've decided that you're ready and that angel investment is the way to grow your business. So where do you find them? So as I said earlier, anyone can be an angel investor if they have the financial capacity to be. The problem is that they tend not to walk around town with badges on. You might be lucky enough to know wealthy people who are willing to support you, but that's not the case for everyone. You might have other founders in your network who might be able to introduce you to some of their angel investors. Equally, if you join an incubator or an accelerator, the people who run those may have a small network of potential investors around them. So there are what we call lone wolves out there, but they're difficult to find. And most angels don't publicize that they're angel investors. That said, I think it was Thomas mentioned one of the videos earlier, sometimes it can be really effective to reach out to individuals that you know have the capacity to invest and that you feel would be particularly helpful to you because of the industry that they're in, or the experience that they've had. But 75% of UK angel investors are members of investor networks like Anglia Capital Group, for example. And also early stage funds tend to be linked to angel groups, as I mentioned earlier. So approaching angel groups can be one of the most effective ways of accessing angels and early stage funds all in one go. And the UK Business Angels Association, which is the industry trade body for angel investors, is a great place to find a list of groups to approach in the UK. So now I'll explain the process that you might go through when you approach an angel group. And to do this, I will use Anglia Capital Group as a model, but it's also safe to assume that most angel groups do follow a similar process to a lesser or a greater extent, all depending on how professional the group is. So my title is officially Investment Director and MD, but the industry term for my role is actually gatekeeper. It's not very sexy though, so you won't see it in my email signature. But every angel group or network will have a gatekeeper. And the gatekeeper's main job is to select some of the best early stage businesses to pitch to their angels in the hope of raising those businesses some investment. I will remind you here that angels are different, and therefore all angel groups will also be different in order to adapt to their members' wishes. So when I say we select the best, it doesn't necessarily mean that the ones that don't get through aren't good investment opportunities. Part of my role is to understand our investors and what they are looking for. So my decisions, as well as looking for all the things that Andrea's discussed in previous slides, are based on things like what sectors are most popular with our members at the moment. Or in Anglia Capital Group's case, we prioritise East Anglia-based businesses over businesses based in other regions. So the point is, if you don't get past one gatekeeper, it doesn't mean you won't get past the next one. Different angel groups have different criteria. For example, some might be geographically strict or biased like us. Others might be sector specific. So the Green Angel Syndicate, for example, only invest in environmentally sustainable businesses. The Startup Funding Club only invest in SEIS rounds for the added tax benefits, and the list goes on. And I think Andrea made a good point earlier, not to put all of your eggs in one basket. So the majority of the time, a business will need to pitch to multiple angel groups in order to fill the round. And that's fine, because angel groups, they don't tend to compete with each other. They tend to take a more collaborative approach for deal sharing and co-investment purposes. Also, Anglia Capital Group are a regulated angel network. So our screening process is slightly more formal than you might find in other non-FCA regulated groups. But on the whole, though, most angel groups do have a screening process, and it tends to follow this similar pattern.
Sorry, Hannah, we can't see the writing up. There's just a triangle.
It was supposed
oh, okay.
So it starts with the application. Anglia Capital Group have an application form which you can access via the website. Other angel groups, they might just ask you to send through a pitch deck or an executive summary to the gatekeeper. And this is where it's extremely important to have a good pitch deck or summary with all of the information laid out in a clear format. You can, if you imagine applying to a job in a large company, we've all heard the story of HR teams picking up half the pile of CVs and chucking them in the bin. It's not quite that harsh in the angel world, but we do have to whittle down a fairly significant pile of investment opportunities at this stage of the funnel. So you need to make sure that you're ticking the right boxes for the angel group that you're applying to. If you manage to interest the gatekeeper with your deck and you tick the boxes for that group of angels, then the gatekeeper will follow up with you to learn more about the opportunity. So at this stage, I'd usually request a meeting. And at that meeting, I'd want to see a pitch from the founder to kick it off. And that's for two reasons. One, I want to see if they're pitch ready. And two, because a verbal pitch in theory should answer quite a lot of the questions that I've written down going into the meeting anyway. The gatekeeper then has the difficult task of selecting a final bunch of companies to go through to the screening committee in advance of the scheduled pitching event. Before that, though, those businesses that I've selected, I'll start requesting information from them to complete some due diligence. And the due diligence that I'm completing at this stage is either for regulatory reasons or to check that there is they have the substance and the materials behind the pitch that an investor will want to see if they start to seriously consider investing. And so this is important. This is the stage where it's really important to have all of the items that Andrew was talking about earlier in one place, ready to share with me. Otherwise, you'll find that you'll come to an absolute standstill. But if you pass the due diligence stage, you'll be invited to pitch to the screening committee, which is the final hurdle before any introduction to our investors. So our screening committee at Anglia Capital Group is made up of volunteer angels from the network and some of our corporate partners and friends. And at each meeting, the panel will watch the pitches of the businesses that I've selected up to this point and make a decision on which companies they think will appeal to the other ACG members at the next meeting. And the number of businesses to select is, of course, determined by the capacity of the upcoming event, time-wise. But if the business is successful at this final stage, they'll be given the opportunity to pitch at a formal ACG investor event and hopefully interest some angel investors to learn more. But this is when we realize that this is just the tip of the iceberg for founders. They then have a whole new process to go through with the interested investors. The good news, though, is for the businesses that have come through Anglia Capital Group, our screening process has hopefully ensured they're ready for it. Over to you, Andrea.
Okay, so what does it look like from the investor's perspective? So you're interested in the company, you've seen the pitch, and now you need to evaluate whether it's something that you actually want to invest in. And so what happens is we usually get together in groups. And I mean, one recent example was I was in a group with 3 investors following the pitching event. We would have a meeting with the company itself to ask any additional questions. We'd have access to the data room with all the information that I mentioned previously. And then what we do is, between the three of us, we agreed who was going to look at which particular aspect of the company we were going to look at. So there was a lawyer, and he obviously looked at the legal aspects. There was another investor, and she was focusing very much on the marketing and sales side of things, so she took that. And I was looking at the health and safety aspect. It was an environmental company that had a screening mechanism for a particular pollutant. And we worked really well together because we all relied on each other, and we had expertise in a particular area. Now, one of the things that we'd identified was that they were slightly weak on the marketing side. They'd very much focused on the invention, so the detection system. And one thing they hadn't thought ahead of is, once we've got our minimum viable product, then actually, how do we sell this product? So that was something that had come up. Unfortunately, because that company was talking to another angel group, that angel group had filled the round, so we didn't get a chance to invest. But recently, that company came back for a second round. And so we could pick up all the due diligence that we'd done previously on it. And I had particular look at the marketing aspect. And unfortunately, whilst they doubled the size of the team, they still hadn't put in place any salespeople to sell the product. So again, I declined it on that basis. But that's literally the kind of process that we would go through. Now, say, for example, we decide to invest, then there's a negotiation phase. So you might delegate that to one investor, or you might find, as a company, you're dealing with 3, 4, 5 investors. It actually becomes quite difficult then. So it's much easier if you can persuade the investors to work as a group, because otherwise you'll be constantly going backwards and forwards between all of them. And then you get the final decision. I think one of the key things here is keep communicating as a company, keep communicating with the people that are negotiating. They're usually quite busy people doing other things. It's not because they're not interested, but they do need moving along sometimes. And then hopefully you'll get the decision that you want. But it doesn't end there. So the relationship is long term. Having given the money, please make sure that you keep reporting. And it's key. Hannah mentioned previously, don't forget that you might need more money in the future. And as I've already said, I'd expect companies to come back at least 3 times for more cash. So if you send quarterly reports, that's fantastic. If you only report once a year, then you can't expect the investors to react quickly when you come for your second round. The other thing is that one of the reasons we're doing this is because we want to help. And so, you know, go and ask your investors for help. People don't usually say no. They usually say yes because they want to assist. So keep engaged even after that first investment.
Great, thanks very much. So we'll just finish up today with a couple of case studies from Anglia Capital Group's portfolio. Hopefully a bit of inspiration for any founders in the virtual room today. So Suffolk-based PBD Biotech. They were founded in 2014 as an academic spin-out. They had discovered and patented a phage-based diagnostic for tuberculosis, TB. They began their first clinical study in 2017, and that was after they'd raised 400,000 from Anglia Capital Group and also Cambridge Agritech Angels. Their first product was a diagnostic test kit for use in agriculture, in particular cattle. Bovine TB is a huge issue worldwide, and it actually leads to the slaughter of many cattle due to not being able to diagnose affected cows early enough to stop the spread to the rest of the herd. And actually, if any of you have seen the recent season of Clarkson's Farm, you'll be aware of how big a problem that is for farmers financially. So the test what it was and is significantly more effective and efficient than the current market standard, which requires samples being sent off to laboratories. But despite a groundbreaking product, the team and its shareholders were struggling to enter the market. But at the same time, they realized that their product had an application in a much bigger market, the human TB diagnostic market. So in 2019, the business pivoted to focus the use of its technology on humans, and this started to draw the interest from venture capital due to the much greater potential the business now has in terms of financial growth. And sure enough, it was late 2021, early 2022, PBD Bio raised a staggering 2.5 million to fully focus on the human TB market. And they're now well on their way to full commercialization. Just another one for you, Norfolk-based developing experts. These guys were founded in 2014. They raised 335,000 from Anglia Capital Group in 2018. And at that point, the business was valued at 1.5 million. They then raised further investment through Anglia Capital Group in 2019, 2020, and today the business is valued at £7 million. And I'll let Sarah tell you about it.
Can't hear it, Hannah. You just need to share audio.
Oh, I'm going to do that. I'll just pause for a sec while I figure that out. Share sound.
Actually, I founded the company in my front lounge in 2015, October, and with my co-founder Shane Morgan. And it's quite a different product from the original concept. So what we do now is create talent pipelines for industry. And we do that by enabling governments to strategically plan for their economic future. It took us 2 years to get to the point where we had a working prototype that instilled enough confidence for schools to actually purchase the product. So in September 2017, we had 11 schools paying for the product, but we just kept working at it, and we built the point. We got to the point where industry experts were beginning to be prepared to feature in the platform because we wanted to show the applications of lessons in the world of work. And once we got to that point, well, we had a few professors and doctors who were almost endorsing it because of their appearance or being featured. 2 months in, so October 2017, I thought, right, let's give it a go. I had a high net worth individual who was a personal friend as well. And I just said, look, this is what I'm trying to do, gave him the full pitch. And he said, yeah, I'll back you. I made the decision in 2019 that I wanted to change the business model. And as part of that decision, I decided that we're never going to make money for the company if we charge or look to schools to monetize the product. And I thought, right, we need to team up with industry. And at that point, right, I thought, if I was going to team up with industry and monetize it through industry, how am I going to really disrupt the market? So I just made the decision to make the product free to schools. And at that point, this is 10 months before COVID, and it just, a series of things just lined up perfectly. When COVID happened, it just grew the school base, and immediately we had this everyone discovered us, and we went from I think 250 schools to now 5,800 schools, and so each week I would post on a heat map where all the schools were on social media, and me doing these heat maps each week just created a viral campaign online, and teachers talked about the product. So that was probably, making the product free was quite instrumental in helping the company gain credibility. I always wanted, at the beginning, when you're asked to pitch to Anglia Capital or any pitch event, they always say, "Well, what's your exit plan? What's your exit plan?" And I've always, at the beginning, I just thought, what's an exit plan? I didn't even know what an exit plan was when they were asking me. And I thought, okay, once I understood what it was, I thought, right, I'm going to, I'll give it 5 years. I think I can get to the point where the company's where it needs to be in 5 years' time, not really understanding what I was committing to. And 5 years is 2022. I don't think we'll be where we need to be in 2022, but I'm fairly certain we'll be where we need to be in 2023. The advice I'm getting is you wait till you're actually on that hockey stick curve. And we're pretty much on that hockey stick curve point where we then look at how we can get the greatest return for our angels.
It's actually interesting as a side note that both PBD and developing experts had a point in their journey where they realized they needed to pivot the business in some way to more effectively scale the business for their shareholders. So we've covered an awful lot over the last hour or so, and I really hope that you've got something to take away. But just to recap on a few of the things we've learned before I hand over to Laura. Financing options for businesses, they essentially can boil down into grants, debt, or equity. Equity is most useful for businesses that have significant growth potential. And angel investment is a great source of capital for startups, and it comes with other benefits, not just the capital. Founders need to be careful about selecting investors just as much as the investors are about selecting them. You need to put yourself in the shoes of the investor to understand their motivations. You need to be ready for the whole process of raising capital, all of the materials in place. And angel groups are the easiest and most efficient way to find angels. And that's it. I'll hand over to Laura just to tell you a bit about the Halo programme.
Fantastic. Thank you, Hannah. Good afternoon, everyone. It's really great to see so many of you here today, and well done for sticking with us. We're nearly at the end. So I'm Laura, and as Hannah said, I'm the programme coordinator for the Halo programme. And we're really excited to bring you this new programme. We're hoping to see many of you joining us for it. So what is the Halo programme? Well, through our years of working with early stage companies and seeing many, many pitches, we realised that there is a real need for founders to access support and guidance to make sure they're really ready before they undertake that all-important pitch to investors. So as you heard earlier from some of the Anglia Capital Group angel investors, yes, they do expect to see a good pitch, but there's so much more that needs to go along with that. And this is where the Halo programme can help you to get everything in place before you meet with investors. All of the sessions will be delivered by industry experts, and we're really, really lucky to be working with Burkitt solicitors, RSM accountants, tech partners who are recruitment specialists, and our friends at the UEA and University of Suffolk. And we're also really delighted to be able to offer angel investor mentors to each founder who takes part in the programme, and those mentors will be there throughout the duration of the programme. So we'll be covering key topics including understanding your marketplace and go-to-market strategy, financial forecasts and tax, valuing your business, which is always a really interesting one, understanding shareholder legal documents, which we touched on today, HR, and building the right team. We'll then go on to the all-important pitch, where you'll learn what to include in your pitch, the structure, and what investors will be expecting to see. And this will be followed by a pitch practice workshop, which will be an interactive session where you'll have the opportunity to get feedback from your course peers and also from a real angel investor who will sit in on the session with us. So the programme will then culminate in a pitch showcase event. And this is where all the hard work will be put into practice and you'll pitch to a panel of real angel investors. So at the end of the course, you'll receive a personalised pack, and that will include constructive feedback from the angel investor panel, an investment readiness checklist, and supporting materials from our partners. So as well as helping you to get ready to pitch for angel investment, the Halo programme will bring you together with your community of founders. So you'll have the chance to get to know other founders who are going on the journey with you. You'll also have access to an online portal, and this will include all the course materials and also a discussion board for you to interact with your peers and mentors in between the sessions. So after this webinar today, you'll receive a short questionnaire, and it will ask you about for some feedback on the webinar today, but also ask you to let us know if you're interested in taking part in the programme, and we really do hope to see many of you there. So that just about concludes our formal presentations. Thank you so much, Hannah and Andrea, for your input. And we've got a little bit of time left, so we'd love to take some questions from you. Please raise a hand or just yell or put it in the chat, whatever works.
I've got a question.
Go for it.
There was a really good slide that you put up, Hannah, just before the sort of case studies, and it was the little the funnel coming into eventually going in front of the investors and investors indeed investing. I just wondered, you might not have the answer to this, but I just wondered what the sort of level of businesses that get through each of those stages was. You know, I mean, obviously you must meet loads of people, they're not quite ready yet, and then they'll go through the sort of the stages before they get to the investors at the end.
Yes, and I can answer it. I can definitely answer it from an ACG, Anglia Capital Group perspective. And I did read somewhere that 6% of businesses that seek angel investment in the UK actually achieve it. So that's the sort of UK-wide statistic. With us, it's probably, if you say there's 100% at the application stage, it's probably somewhere between 1% and 3% receive investment. About 5% get through to, being introduced to the angels. So it's quite a competitive funnel, and this is why businesses need to be prepared for, with all the materials in place, and also just understand what the angels are looking for. Because a lot of the time it's not that they don't have a great idea, it's just that they aren't ready.
Interesting. Hence this program is going to be quite useful for people.
We hope so. We hope so.
Oh, Alex?
Yeah, hiya. So I'm looking to raise some money. I think our business has got to the point where I can't do much more on my own. I need some help. And I initially had a figure in mind, but I was speaking with the sounding board and some mentors through them, and that figure has gone up dramatically. If we, say need the sales staff and we need expensive people who can get into the markets that we need to. So would you recommend lots of smaller amounts or one big amount?
Do you want to take that?
I think one thing that I would say is that it's really labour intensive. So trying to raise money. And so it'll take you away from the business that you're currently doing. So you need to make sure you raise the right amount. So I would say go for as much as you need, at least to give you a runway for preferably 2 years. what we don't like to see is if the businesses come back too quickly, they burn through the money too quickly, and then you think, well, that's not very good planning, because if you've only planned for 6 months, then you're constantly going to be on a fundraising drive. So, you know, if you can get a 2 years runway and then end up spending it in 18 months, then that's probably okay.
Just to add, yeah, I absolutely agree with Andrea there. Just to add to it though, sometimes when founders go out to raise capital, they think about how much equity they want to give away, and that then determines the valuation that they put on the business. But if you decide that you need quite a lot of money, say, I don't know, £2 million at the very early stage, then you need to think about the effect that has on your valuation given the amount you want to give away. And sometimes you do need to break up those types of investment rounds in order to make it achievable and hit certain milestones so you can increase the valuation for each raise. Makes sense.
Could I just ask when the Halo program's starting?
Yeah, so we don't have a fixed date yet, and we're working with Nick on that. So after this session, you'll get the form to register interest, and once we've got an idea of how many people want to be on the programme, then we'll look at sending out some dates. So hopefully very soon we'll be able to let you know.
Okay, thank you.
Any other questions?
On equity.
I think Alex is speaking, but we can't hear you, Alex.
Oh, can you hear me now? How about
Yeah.
I talk really close?
Faintly, yeah.
Oh, sorry. So yeah, a question on equity then. So clearly we're all here because we want our businesses to grow. So they're not worth as much now as they will be in the future. So how do you calculate that equity?
Andrea?
I knew that was going to come back to me. So I think one of the things that I will be running as a session on valuations in the programme, and Claire's smiling because she's already heard me talk about valuations and actually done 40 hours of valuations with me. And I think one of the things about valuing startups is there is no formula, and so actually it's very much dependent on your business, where you've got to with your business, and in the end it's all about who is willing to put money into your business. So I think one of the things is be prepared to negotiate on your valuations. So and it's really interesting because we had some companies, just as an example, usually a sweet spot is valuations of between, I guess, 800 to 1.5 million for really early stage business. Now, a lot of that is based on, so you've got a proof of concept and you've got some traction, so you've got some customers, you've got some people interested. There is no financial formula that tells you how you get to that valuation of 1.5 million, but it is a lot of it is a gut feel about whether you're over or undervaluing the work that you've already done. As I said, I mean, we could talk for hours about how to value the company. I think the key thing is that where we've had companies overvalued and we tell them, actually, you're not going to get through the screening process because the valuation is too high, they've gone away and interestingly had exactly the same feedback from other angel groups and from other angels, so that they've had to adjust their valuation. I think the one place you can't look is the US. The US valuations are huge and they're not comparable to what investors are prepared to pay in the market here. Also, the other thing is if you compare yourself to crowdfunding, the crowdfunding valuation is fixed. And so there is no negotiation. And a lot of people are only putting in like £100, £1,000. They're putting the money in because they want to engage with you as a company and it's a marketing thing rather than they want to make a big financial investment. And so that's why they get away with those valuations, which are, interestingly, we've had crowdfunding rounds straight after or alongside angel rounds, and the valuations have been different because an angel investor is different from a crowdfunder. You know, we like to get involved, we like to help, and we'll put in more money than the crowdfunder. So that probably hasn't answered your question, but it just raised a whole load of other things you need to consider.
Pretty much, yeah. Thank you.
Sign up to the program and come to Andrea's session.
Yeah, we have had a question pop up actually about the program, about will there be a cost involved in participating?
Yeah, so no, the Norwich Research Park Anglia Innovation Partners will be sponsoring the program if it runs. I think there's another one as well.
There is here. So for an academic with early proof of concept, what's the first step? Is it getting a business license? Is that one for Andrea or you, Hannah?
It depends where you are. I think, I don't know about you, Andrea, but I see it quite a lot where businesses register as a company too early or earlier than they need to, and that has a knock-on effect with things like some of the tax advantages that you could use when you do come to raise an investment. So I think don't rush to register your business. Do it when you need to. But that said, when you do raise funds, especially from in terms of equity, you will sort of need to be a limited liability registered company.
Thanks, Hannah. That's all that's come through on the chat. We are almost out of time, so any last questions? If not, we'll let you all go.
Yeah, if not, type in Anglia Capital Group and you can find our contact emails there. Happy to answer any questions that you think of after the session.
Yeah, and look out for the follow-up email with the Google Forms, and just drop us a line if you've got any other questions.
Thanks, everyone.
Yeah, good point. We have recorded the session as well, so we'll share that with you later.
That's brilliant. Thank you very much.
Take care.
Thanks.
Bye-bye.
Bye.
Bye.